Most investors never read an annual report. They avoid them like the plague, intimidated by the sheer volume of data and the clinical language. Instead, they outsource their thinking to social media, news headlines, or the latest hot tip from an influencer. But in the world of professional, institutional investing, difficulty is a filter. The complexity that scares away the masses is exactly where the professional finds their edge. Inside these pages lies the raw, unfiltered truth of a business, waiting for those disciplined enough to look for it. Today, we are going to master the art of reading the annual report. You will learn how to navigate these hundreds of pages with surgical precision, separating the facts from the marketing fluff, and finding the hidden red flags that most people miss entirely. This is your masterclass. The annual report, or the 10K, is the definitive record of a company's performance. It is a legal requirement for every public company, meant to provide shareholders with a comprehensive yearly narrative of the business. It is the closest you can ever get to the source of truth. It covers the strategy management implemented, the challenges they faced, and how they intend to grow your capital in the coming years. It is far more than just a list of financial figures. It is the story of the company's past, present, and future. Before we dive into the data, we must understand the structure. An annual report is divided into specific sections, each serving a unique purpose. The professional doesn't read from page 1 to 300. They know exactly where to go to find the answers they need. We start with the narrative foundation, the CEO's letter. Then we move into the business description, the risk factors, the management's discussion, and finally, the quantitative core, the financial statements. Each section is a piece of a larger puzzle. Many institutional investors begin their analysis with the CEO's letter to shareholders. This letter is a window into the mind of management. It reveals how they think about the business, how they view their competitors, and most importantly, how they handle failure. As you read, look for candor. Does the CEO take responsibility for the year's mistakes? Or do they hide behind excuses like macroeconomic headwinds or unforeseen volatility? A leader who cannot admit to a mistake is a leader who will repeat it. Great leaders use this letter to educate their shareholders. They explain their logic, their capital allocation strategy, and their long-term vision. If the letter feels like it was written by a PR department rather than the CEO, that itself is a major red flag. You are looking for a clear through line between what they said last year and what they achieved this year. Consistency builds trust. Contradiction should be met with deep skepticism. In professional investing, the quality of management is your greatest margin of safety. Before you look at a single number, you must master the business model. You need to understand how the machine actually works. What does the company sell? Who are its true customers? And what makes them come back? You must know the revenue engine. Look for the competitive advantage, the moat. Is it a powerful brand, a network effect, or a low-cost production advantage? If a company doesn't have a moat, their profits will eventually be competed away by more efficient players. The 10K is where they hide the moat. Beware of complexity. If the company's business model requires a PhD to explain, it's often designed that way to hide risks or fees. The professional seeks businesses that are simple to understand but difficult to replicate. Clarity in the model leads to conviction in the hold. If you can't explain how the company makes money in 2 minutes, you don't understand it well enough to invest your hard-earned capital. Never invest in a black box business, no matter how enticing the historical returns might seem. Simplicity is a hallmark of quality. Ironically, one of the most important sections is Item 1A, Risk Factors. This is where the company is legally required to disclose everything that could go wrong. Most people skip this, but the professional treats it as a map of the battlefield. It is a sobering look at reality. They cover everything: regulatory shifts, cybersecurity threats, supply chain dependencies, and currency risks. You aren't looking for a company with no risks. They don't exist. You are looking for a management team that understands their risks and respects them. Ask yourself, are these risks manageable? Has management taken steps to mitigate them? Or are they vulnerable to factors completely outside of their control? Professional investing is the art of managed risk, not the avoidance of it. Knowledge is the ultimate shield. The best companies have anti-fragile qualities, risks that, if they occur, might actually strengthen their position relative to their competitors. Understanding the downside is the only way to truly appreciate the upside. Risk is the price of admission to the market. Next, we move to the MD&A, Management Discussion and Analysis. This is where management explains the why behind the results. They discuss revenue trends, cost structures, and liquidity. It is the bridge between the raw numbers and the corporate strategy. Your goal here is to be a detective. Does management's explanation of the results align with what you see in the financial statements? If they say demand is soaring but inventory is stacking up, the narrative and the reality are in conflict. Trust your own analysis over their words. Look for consistency over several years. Does management have a habit of adjusting their metrics whenever the standard ones look poor? Beware of companies that use overly creative non-GAAP measures to mask underlying weakness. Trust the GAAP numbers first, always. The MD&A should provide clarity, not confusion. If management uses overly complex jargon to explain simple results, they are likely trying to hide something. The best businesses speak with simplicity because their results speak for themselves. Avoid the smoke and mirrors. Now we enter the quantitative core. Item 8. We start with the income statement. This tells you how much revenue the company generated and how much profit was left after all expenses were paid. It is the record of the company's operational efficiency. Don't just look at the bottom line. Look at the margins. Are they expanding or shrinking? A company that can grow revenue while maintaining or improving margins is a company with real pricing power. Revenue is vanity. Profit is sanity. Cash is reality. Analyze the trends. Next is the balance sheet, the foundation of the business. It shows you what the company owns, what it owes, and what belongs to the shareholders. It is a snapshot of the company's financial health at a specific moment in time. It is the bedrock of your investment. Pay close attention to debt. A business with a fortress balance sheet can weather any storm. A business loaded with high-interest debt is a ticking time bomb. The professional investor seeks safety in the balance sheet before seeking growth in the income statement. Protect your downside first. One of the most misunderstood items on the balance sheet is goodwill. This represents the premium a company paid to acquire another business. If a company has massive goodwill but stagnant growth, they may have overpaid for their acquisitions. Look for the impairments. They are silent killers. Look at how the company treats its shareholders. Are they using excess cash to buy back shares at attractive prices, effectively increasing your ownership stake? Or are they paying a sustainable dividend? Professional investors prioritize companies that return capital wisely and efficiently. Finally, the statement of cash flows. In professional investing, cash is king. This section tells you where the cash actually came from and where it went. Profit can be manipulated by accounting rules. Cash flow is much harder to fake. It is the lifeblood of the organization. Focus on free cash flow. This is the money left over after the company has paid for everything it needs to stay in business. This is the money that can be used to pay dividends, buy back shares, or reinvest for future growth. Cash is the final arbiter of value. Follow the money. The professional investor is always on the hunt for red flags. They look for aggressive accounting, frequent changes in strategy, or a sudden spike in one-time charges that seem to happen every year. These are the early warning signs of a failing business model or desperate management. Watch the inventory levels. If it's growing faster than sales, the company might be producing products that no one wants to buy. Watch the receivables. If they are growing faster than revenue, the company might be having trouble getting paid by its customers. These are the cracks in the hull. Be wary of off-balance sheet arrangements. These are obligations the company has that aren't listed on the main balance sheet. Professionals dig into the notes to find these hidden liabilities that can sink a company during a credit crunch. The truth is often buried in the fine print. Pay attention to executive departures. If the CFO or the head of auditing leaves suddenly, it's often a sign of internal conflict or accounting irregularities. The market might ignore these signs initially, but the professional takes them as an immediate signal to dig deeper or exit. Trust is the foundation of the relationship between management and shareholders. Once that trust is broken by a red flag, it is almost impossible to earn back. In the world of serious investing, you don't wait for the disaster to happen. You leave at the first sign of smoke. Guard your capital. One of the best-kept secrets of professional investing is the footnotes. This is where management hides the details they don't want you to see easily. It is often the most important part of the entire 10K. The gold is in the fine print. This is where the detective work begins. In the notes, you will find details on pension obligations, lease commitments, and legal proceedings. These are the contingent liabilities that can destroy an investment thesis. If you haven't read the notes, you haven't read the report. You're only seeing the surface. Deep diving is required. Beyond the 10K lies the proxy statement, or the DEF 14A. This is where you see how management is paid. If the CEO's compensation is growing while the stock price is flat, you have a misalignment of incentives. The professional follows the money and the motivation. Know who is being served. The proxy statement also tells you who is on the board of directors. Are they truly independent, or are they friends of the CEO? A strong, independent board is your last line of defense against poor management decisions. Look for skin in the game. Incentives are everything in business. Large companies are often empires with many different businesses under one roof. You must perform a segment analysis. Which business unit is the real profit driver, and which one is a drag on capital? Don't let a booming segment mask a failing one. Deeply analyze the parts. Segment reporting tells you where the growth is actually coming from. Is it a sustainable core business or a temporary boost from a niche division? Understanding the individual engines of the company allows you to value the whole more accurately. Precision is the key to valuation. In a global economy, geography matters. You must analyze the company's geographic exposure. How much revenue comes from stable markets versus emerging markets? What is the impact of currency fluctuations on their bottom line? You are investing in a global entity. Geopolitics is a major risk factor often buried in the notes. A company heavily dependent on one region is vulnerable to regulatory changes or economic downturns in that area. The professional maps out the global footprint to understand the true risk profile. Be a global thinker. Never study an annual report in isolation. The professional compares the last 5 to 10 years of filings. You aren't looking for a single data point. You are looking for a historical trend. Is the business getting fundamentally stronger or weaker over time? History is the best teacher. Look at the share count over time. Is management diluting you to fund growth, or are they consistently buying back shares and increasing your ownership? Look at the return on invested capital. Is the company becoming more efficient as it scales? Patterns reveal character and quality. By the time you finish this multi-year analysis, you should know the company better than most of the analysts on TV. You aren't guessing anymore. You are investing based on deep historical understanding. This is how conviction is built and how wealth is preserved. Mastery takes time. The goal of all this research is to reach a point where you don't care about the daily stock price fluctuations. You know what the business is worth, and you know why you own it. That clarity is the ultimate psychological defense against market panic. Research is your armor. Before you trust the numbers, you must check the auditor's report. This is where an independent firm certifies that the financial statements are free from material misstatement. If you see anything other than an unqualified opinion, you must stop and investigate immediately. Trust must be verified. Professional investors look for critical audit matters. These are the areas where the auditors had the most difficulty. They are the spots where management's estimates are most likely to be aggressive. The auditor's report is your first line of defense against accounting trickery. Be thorough. Before you make any investment, run through your final checklist. Do I understand the business model? Do I trust the leadership? Is the balance sheet safe? Are the risks understood and priced in? If you can't check every single box, the answer is a decisive no. The checklist is your discipline. In investing, your biggest asset isn't your money. It's your ability to say no. The annual report gives you the data you need to reject 99% of ideas so you can concentrate your capital in the 1% that will actually build wealth. Patience is not waiting. It is a position of strength. Concentration wins. Mastering the annual report is a skill that takes years to refine, but it is the single most important skill a serious investor can have. It separates the gamblers from the owners. It separates the noise from the truth. It is the foundation of long-term wealth and independence. Education is the key. Stop looking for the next hot stock and start looking for the next great business. The information is there, hidden in plain sight, waiting for you to find it. The better you understand the source, the better your life becomes. This is the path of the professional. Walk it with discipline. Annual reports are not marketing brochures. They are primary sources of truth. Most people will never read them because they are difficult and time-consuming. And that is exactly why they are so valuable to you. Knowledge is your ultimate edge in a chaotic market. Stay focused on the source. The market is a machine for transferring wealth from the impatient to the patient, and from the ignorant to the informed. By mastering the 10K, you are choosing which side of that transfer you want to be on. Stay disciplined. Stay professional. The source is your only truth. Your homework for Lesson 2. Download the latest annual report for a company you admire. Don't look at the stock price. Don't read the analyst reports. Just read the 10K. Answer these questions. How do they make money and what could stop them? Find the moat and find the risk. Write down your conclusions before you read anyone else's opinion. This is how you build your own conviction. This is how you become a professional. The journey to financial mastery begins with the original source. I'll see you in Lesson 3. Stay disciplined. Stay hungry for the truth. Subscribe to Wealth Entertainment 21 for more advanced investing lessons. Turn on notifications so you never miss a deep dive into the world of professional finance. The best investors don't chase information. They study the source. Join our community of serious investors. In Lesson 3, we will learn how to evaluate management quality. We will separate the visionaries from the pretenders and the builders from the destroyers. Management is the ultimate variable in long-term success. Stay disciplined. Stay focused. I will see you there.